Hello and welcome to the January 2018 Educational and Economic Update offered by Les Goldstein, President and Founder of Personal Financial Strategies Incorporated. As we begin the year, I thought it would be a fine idea just to share with you all about the tax changes that will impact your 2018 tax picture. According to Wikipedia, the Tax and Jobs Cut Act of 2017 was introduced to amend 30-year-old tax code. Elements include reducing tax for businesses and individuals, increasing standard tax deductions and family credits, the elimination of personal exemptions, limiting deductions for state and local income taxes, property taxes, further limiting the mortgage interest deduction, reducing the impact of alternative minimum tax for individuals and even eliminating it for corporations, and repealing so-called Obamacare. So here are some details of that very quick summary, details that probably will impact you the most. Number one, the standard deduction for 2018 is nearly double that of 2017, rising to $12,000 for single filers and $24,000 for couples filing jointly. A potentially negative impact of this change is the possibility that charitable deductions and charitable contributions will fall. Charities are afraid that contributions may fall by 50% or more, as many fewer taxpayers will be itemizing and therefore not contributing to charitable causes. Number two, another change of significance is that billions of taxpayers will not benefit from deducting mortgage interest. This again is the result of the doubled or nearly doubled standard deductions. Number three, another negative of the change in tax laws is that interest on home equity lines of credit is no longer deductible at least through the year 2025. There is an exception to this. If the proceeds of the loans are used primarily for home improvement, then the interest will still be deductible. In the past, it wasn't tracked, the reason for the utilization of the home equity line of credit, and now it is. Number four, you can deduct just $10,000 in state, local, and property taxes. In 2017, deductions for state and local taxes were unlimited. This change is widely seen as a hit to blue states such as New York, Connecticut, and California, and there are concerns that this could cause property values to fall in high-tax cities and leave less money for social good. Number five, an actual positive change is that the income tax levels that would result in alternative minimum tax have been much increased, and the threshold at which the alternative minimum tax exemption phases out has been increased as well. The final form of the tax agreement also specifies that both the exemptions and phase-outs would be increased by cost of living adjustments beginning after 2018, where in the past this did not happen. These changes will dramatically impact the number of filers who are impacted by alternative minimum tax over the next decade. Number six, here is a benefit that will flow only to the wealthiest of U.S. taxpayers. The so-called death tax or estate tax was doubled to $11.2 million per individual and $22.4 million per married couple, indexed for inflation. Now, this is only good for the next 7 years through 2025. No one knows if this will be a permanent change or if the next administration will change things after this lapses. Number seven, another positive change is that the use of 529 plans has been expanded. Before it was just for college and graduate education. Now it includes education for kindergarten through the 12th grade for private schools. That's 529, benefits expanded. Number 8. Here's one that's maybe a win for certain small business owners. The owners of so-called pass-through entities like S corporations or LLCs, even sole proprietorships, used to have a top tax bracket of 37%. Now, there is a new deduction of 20% of net income from any pass-through business, effectively lowering the corporate tax rate of these pass-through entities. Please know that certain service businesses, such as law firms, doctor's offices, and investment offices, can take the 20% deduction only if they earn $315,000 or less as a married couple. Number 9, another positive is that the child tax credit has been doubled from $1,000 to $2,000 for each child in a family when that child is under the age of 17. And many more families will be able to use this tax benefit because it phases out at a much higher level of income, $400,000 for couples, $200,000 for singles. This is actually a very valuable benefit because a credit is much more beneficial than a deduction, because a credit is a dollar for dollar tax savings, where a deduction just saves you based upon your tax bracket, maybe 25 cents on the dollar. So, according to the Tax Policy Center, about 80% of tax filers will see a tax savings in 2018, about 5% will see an increase, and the rest will see no change. So if you're still working, you need to adjust your papers at work so to properly cover the new changes by filling out a new W-4. So, how will all of this affect the economy? A Wall Street Journal article of private sector economists showed that 9 out of 10 felt that the tax bill will boost the economy over the next couple of years. Most economists see only a modest increase. The long-term effects, however, have split opinion as to how much benefit will actually accrue to our economy as a whole. The tax cuts overall could boost growth in at least 2 ways. First, by raising demand. In the short term, with businesses and individuals having more money, the demand for goods and services rises, pushing up prices, pushing up demand, spurring economic growth. In the long run, if businesses truly have more capital available due to the repatriation of funds overseas and the lower tax cuts, this could boost long-term investment, more workers, more capital expenditures, economic benefits. One obvious beneficiary of these economic and tax changes has been the U.S. stock market. Year to date, the S&P 500 is up over 4%, the Dow is up nearly 2%, and the NASDAQ has been flying up nearly 10% from January 1 through March 12 of 2018. So, while we believe that the information in this report is accurate, we cannot guarantee its reliability or its accuracy. Opinions expressed herein are subject to change and are not intended as investment advice or a solicitation for the purchase or sale of any investment security. Please call us here at PFS Wealth Management at 847-268-3670 to speak with your financial advisor about your personal situation. As always, we look forward to speaking with you and seeing you soon. Les Goldstein signing off for January 2018. Bye-bye.